Our next area is working capital management part 1. And what are the areas the sub areas or the subtopics we will be covering within M4? We will be discussing inventory management strategies, supply chain management, and finally the accounts payable management. So let us discuss these subtopics one by one. Inventory management. Inventory management has further these topics under discussion: types of inventory valuation methods, periodic versus perpetual inventory valuation methods, cost flow assumptions, and that's all. So let us discuss what are the types of inventory we have and what basically is inventory management. Remember, inventory is your current asset, quite a sizable current asset. Some companies that are specifically engaged in trading business like FMCG or like wholesalers, they will have quite a sizable investment in their inventories. So that's a very important area for them. So there are three types of inventories. Raw materials inventory means these are the materials we use in production process. Work in process, these are partly finished goods. Still the work is going on, but they are not yet completed. We discussed this in CMA. Most of you guys are management accountants, you know this. And finished goods, of course, these are the goods which are ready, perfectly ready for use. Inventory valuation. We have two methods for inventory valuation. First is the LCM rule. It's applicable only in the US GAAP. And second is the lower of cost or NRV. I will explain these in detail. LCM rule basically is applicable and allowed only in the US GAAP if your inventory is valued using LIFO, remember, or the retail method. Remember, if your inventory is valued using LIFO or retail method, only then you should use LCM rule, right? Only under US GAAP. In all the other methods, FIFO, weighted average method, moving average method, we use the lower of cost or NRV. Now I will explain what this method is all about. In LCM rule, you keep your cost at one end and you take three values on the other end, what you call the floor, the ceiling, and if any value falls between this, which is normally the replacement cost. The floor is NRV minus normal profit margin. It's all from CMA. I'm sure most of you would have gone through it. Floor is NRV minus normal profit margin. NRV is your ceiling, and replacement cost can fall either above ceiling or below ceiling. So basically there are three values, and any of these could be the designated market price. First is NRV, net realizable value. I'm sure you know how to calculate. NRV is the final selling price minus cost to complete and cost to sell. I'm sure this is a very basic fundamental concept in accounting. Floor, NRV minus normal profit margin. I will explain this idea with the help of an example. And replacement cost, basically it's the price currently prevalent in the market. This is the cost to purchase. If you just want to replace the inventory, the price that is prevalent on the valuation rate, that's what you call the replacement cost. Now, out of these, rather than going for ceiling or floor, my recommended approach is you should take NRV minus normal profit margin, NPM, and you should take replacement cost. Whichever of these is the mid number, median, whether replacement cost, NRV, or NRV minus normal profit margin, whichever is mid number or the median, that median must be compared with cost. If your cost is, let's say, 100 and the median of these three is 95, that means your inventory is impaired. You have to charge $5 loss in your inventory. Whereas if your cost is 100 and the middle of these three happens to be 105, then there is no impairment. Remember, under the US GAAP, impairment loss once charged to income statement cannot be reversed subsequently. So that's the LCM rule. I will explain with the help of an example in the next slide. Then what is NRV? Lower of cost or NRV. This is a different approach. This is used if your inventory is measured under FIFO, weighted average, HIFO, NIFO. There are many other methods. Anything other than LIFO and retail method, the valuation method would be lower of cost or NRV. Now, on one hand, you have cost, which is $100, let's say. On the other hand, you will have to calculate NRV, which is simple. final selling price minus cost to complete and sell. And if it happens to be $95, then your inventory must be brought down from 100 to 95. Or if your NRV is 110, then there is no need to write down your inventory. So this is the rule we used, LCM rule, if the inventory is valued under LIFO, a retail method, and for all other methods you use lower of cost or NRV, and this is applicable both under the US GAAP as well as IFRS, whereas LCM rule is only applicable under the US GAAP. So that's the important point I just told you. Market value, the designated market value. LCM rule basically stands for lower of cost and market value. So under LCM rule, the designated market value is the median of these three. Replacement cost, which is the current prevailing price on the valuation date. Market ceiling, which is NRV, remember, and market floor, that is NRV minus normal profit margin. So middle of these, the median of these three is the one where you will compare your cost with, right? Let us do an example. This will explain the idea in detail. 6 months ago, Duffy Incorporated purchased inventory for $55. This is the cost, remember. The current replacement cost, okay. Let us do this question first with LIFO. So we have cost at one end, which is $55. Okay. The current replacement cost I'm going to write is RC, which is 48, while the net selling price less cost to complete, which is basically NRV. Remember, the net selling price less cost to complete, less any cost to sell is 51. This is NRV, which is normally called ceiling. You don't need to remember if it's called ceiling. It happens to be 48. No, 48 was current replacement cost. That is 51. And finally, your floor, which is NRV minus normal profit margin. Normal profit margin is 5. So 51 less 5 gives you 46. Now take the median. Take the mid number. Which of these is the middle number? This is too low, this is too high. So your replacement cost is the median, the middle number. Now you compare your cost with the middle number. Your cost happens to be 55, whereas your replacement cost is 48, which is the designated market price. So you have to reduce your inventory by $7. This is only when you are using LIFO. Remember, determine the value of inventory on the balance sheet date if the inventory is costed using LIFO. That's what you do. You use LCM rule. LCM rule stands for the lower of cost and designated market price. And what is designated market price? Designated market price is the middle of these three numbers. And you compare that mid number with the cost. Whichever is lower becomes the base. Now let's do the same question using the FIFO approach. FIFO says just take cost on one side and take the NRV on the other. Khalas, nothing else, just NRV. Just NRV. So if the cost happens to be 55 and NRV is 51, so in that case you have to lower your inventory value to 51 and you need to charge $4 as the loss to inventory. Remember, so 48 will be the value in case of LCM rule and 51 would be the value in case of the lower of cost or NRV. So this is very important to be noted down. Next we have inventory management, periodic versus perpetual inventory system. Remember, there is quite a sharp difference between these two. When we say periodic inventory system means we do not keep separate inventory records. At the end of the period, we go for the physical counts, and at the end of the period, we calculate CGS using this formula. Your cost of goods sold is equal to opening stock for the period plus any purchases we made during the period minus the closing stock determined by physical count. Your CGS determined using the actual physical count of your inventory at the end of the quarter, at the end of the year, and that's how we determine the CGS, right? This method is quite outdated, used in mostly older businesses, those who haven't yet used computerization. So periodic method involves physical count of the inventory at the end of the counting period, quarter or year or monthly, whatever the period you might have set for yourself. But under the perpetual inventory system, the meaning of perpetual means always updated. So under the perpetual inventory system, inventory is updated with every sale, with every purchase, which means you will have your cost of goods sold available every time. You will have the value of your closing stock in inventory in the system every time. So which means your inventory is updated with the every receipt, with every purchase, every sale. You will always get updated number from the system. Whereas for periodic inventory, you will have to go for the physical count to determine your CGS for the period. Right? So that's the important point we've just discussed. Periodic involves the physical count at the end of the period, whereas perpetual inventory involves updating records after each sale and purchase, which means the data is updated almost at any instant when you buy or sell. Next, cost flow assumptions. We have 4 cost flow assumptions. Specific identification method. The items are distinct. Items in our inventory, they are so distinct that they can be separately identified and their cost can be separately tracked. So specific identification method is used when the inventory items are so distinct and so unique from each other that we can easily track, we can easily trace each item in our accounting system. Then the second method, we have the first in, first out method. I'm sure most of you know this, what it means. First in, first out cost flow assumption means the earlier costs, the older costs, they are charged to cost of goods sold, and your latest costs, the items which you just purchased at the latest prices, your latest cost, they go to your closing stock. Remember, first in, first out means your older costs, they are charged to CGS, and your latest costs, they go to closing stock. I'm sure you would know from this. Whereas in last in, first out, it is totally reverse. In last in, first out, your latest in, latest price is charged to CGS, whereas your older costs, they are charged or they are taken to the closing stock. So they are totally opposite. Remember, this LIFO method is only permitted under the US GAAP. It is permitted in China, whereas LIFO method is not permitted. It is not allowed under IFRS. And then weighted average method, it simply calculates the average of the cost for the whole period. Like for example, we had goods worth 100 at the start of the period. We bought goods worth 1900 during the period. So the total value of the goods over the period was 2000. And let's say there were 20 units in all the period, including opening stock plus purchased. So you will get an average rate of $100 per unit. Just a simple example. Weighted average doesn't consider when the goods were bought. It's all just you have to take the opening value of the stock plus the items purchased and divide with the total units in hand during the period plus including the opening stock. This will give you an average rate, and this rate will be used for whole the period for the purpose of CGS and for the purpose of calculating the closing stock. And yes, important point here, moving average, very unlikely you will be tested on this on your BEC exam. Moving average is used under perpetual inventory system, where every purchase, every sale will update your accounting records and you will come up with the new average rate. Every purchase, if the prices are changing, every purchase will revise your average cost. If the prices are going up, your average cost will go up. If the prices are going down, every additional purchase, your average cost will fall. So moving average means your average cost is revised with every new purchase or every new consignment we receive. Okay, now next topic we have is the inventory management strategies. So what we will be covering in this, we will be covering factors affecting inventory levels, what should be the optimal levels of inventory, safety stock, and reorder points. So let us first discuss the factors affecting inventory levels. As I told you, inventory could be quite a significant investment. So management must carefully plan the level of inventory. Too much inventory means too much money is being stuck, is tied up, which has an opportunity cost. Too little inventory means that you might lose on the customer orders. So you need to strike quite a delicate balance, neither storing too much nor storing too less. So that's important. You need to establish an optimal inventory level, which is neither too high nor too low. Okay. What do we mean by safety stock? Safety stock is the minimum stock that you should have so that your customers do not go empty-handed. You must have sufficient stock so as to meet the needs of your customers. For this, And what should be the level of safety stock? It depends upon some factors. Let us discuss these. The safety stock depends upon the reliability of your vendors. If your vendors are reliable, then you can keep little safety stock, because you will have some element of confidence on your suppliers, so they will deliver when you need them. So you don't need to keep too much safety stock. But when your vendors are unreliable, deliveries can be late. So in that case, you need more safety stock. Then what if your customer comes and you do not have anything to sell? You could lose a lot of money as what you call the loss contribution. So if there is a risk of stock out cost, this is called stock out cost. A customer comes, you don't have the good, he goes empty-handed. This is a loss to business. This is called lost opportunity, lost contribution. This shouldn't happen. This is called stock out cost. This shouldn't happen. This shouldn't happen. Then next point important for determining safety stock level is the lead time. What is lead time? Lead time is the time lag between placing the order and actually receiving the good. Let's say you purchase or place the order at 1st Jan and the goods arrive on 15th of Jan, for example. So it means the lead time, the time lag between placing the order and actually receiving the good is 15 days. That's what you call the lead time. If the lead time is longer, you will have to keep larger safety stock. But it takes just 2 days to collect the material, then you can have lower safety stock, right? And of course, you cannot ignore your specific business circumstances. Maybe if your business is seasonal, then you may have to change your safety stock depending upon the season you are currently in. Then the next very important point, reorder point. At what level should we place the order? For this, we have an interesting formula. Safety stock, like we should always have a certain level of stock with us. Lead time, the time it takes to receive the goods from our vendor, and sales during the lead time period. This will help us determine a point called the reorder point. This is the point where we should place the order. So let's do a question explaining the idea here in the next slide. Worldwide widget sells 8,000 widgets per year. Manufactures widgets in groups of 1,500. This is the grouping in our production. This is what we sell every year and requires 5 weeks of lead time. That's the lead time okay. Worldwide also maintains an absolute minimum safety stock of 1,200 widgets. This is the minimum stock. Assuming 50 weeks a year and a constant demand, compute the worldwide's reorder point. We have just seen reorder point is equal to safety stock plus lead time, which is 5 weeks multiplied by the weekly demand, or the demand during the, demand during the lead time. So what you're going to do, you're going to divide your 8,000 annual demand with 50. So 8,000 upon 50 gives you 160. So you need 160 widgets every week, right? And there will be 5 days of lead time between the time you place the order and you receive the goods. So 5 multiplied by 160 plus 1,200 gives you 2,000. So if your inventory falls to this level, you should place the order, because by the time the goods will arrive, you will be exhausted with these items and you will reach your safety stock. So this is the point. So now this safety stock of 1,200 units, how it is determined, we just discussed. It depends upon the reliability of your vendors, the lead time, also it depends upon the seasonality, stock out costs. So this could vary from business to business, of course. So that is the idea. Next is an interesting concept. Economic order quantity. Economic order quantity is an interesting concept. It's an order size. There are 2 types of cost related to the purchase of material. One is the ordering cost. Other is the carrying cost. I normally call it as the holding cost. When you place too many orders, your ordering cost will go up, right? But when you place large size orders, massive orders, your holding cost will go up. They move in the opposite direction. Let me explain the idea. If you place more orders, number of orders, when you place more orders, number of orders are more, your ordering cost will be high. But here, if you place less orders, but the quantity is high and less number of orders, but the size of the quantities ordered is enormous. In that case, the holding cost would be high. So you can see that these move in the opposite direction. We need to find out a balance where the ordering cost and the holding cost, their sum is minimized. And this is mathematically driven through this formula. This is called the economic order quantity. The order size, which minimizes the sum of your ordering cost and holding cost, which is called here as the carrying cost and ordering cost. O here is the ordering cost and HC basically is the carrying cost. So remember, this formula will give you an order size which will minimize the sum of your ordering cost and holding cost. Let us apply this formula. So what's the legends here? EOQ is the economic order quantity, the order size. S is the annual sales in units. O is the cost per purchase order, or called the ordering cost, and C is the holding cost. So if you plug in these variables, the formula will return you the order size that should be placed in order to minimize, remember, minimize the sum of your ordering cost and holding cost. So we have a question here. And I must explain the concept of what could be included in ordering cost. This is important. Remember, ordering costs involve the cost of placing an order, faxing, calling, when you receive the goods, going for inspection, right? Receipt of inventory, counting them. This is all ordering cost. When you receive the goods, you hold them in your warehouse, and there are many other costs here. When you hold the goods in your inventory, in your warehouse, there is rent to be paid, salary of the staff who take care of the inventory, rent of the warehouse, yes, of course, very important point, insurance of your inventory, amount you pay for insurance. Then with the passage of time, inventory becomes deteriorated, it gets stolen, it becomes outdated. All these are in the carrying cost, or what you call the holding cost. Remember, rent, insurance, opportunity cost of tied up funds, pilferage, deterioration, the stock becoming outdated. So all these are carrying costs, or sometimes called the holding cost. So what we want through the economic order quantity, we want to minimize the sum of these two costs. We can't say that EOQ reduces ordering cost or carrying cost. It reduces the sum of these two. This is an important concept to be remembered. Now let's try the question. Okay, so it says Maximus company incurs carrying cost of 50, that is C, and each order cost 562. This is the ordering cost. 5625 is quite a lot of money, and that's what got me surprised. Calculate Maximus economic order quantity if Maximus goes through 100 units of inventory monthly. So that's your periodic demand, not always annual, remember. So this is, I would like to discuss some important point here. Very important point here. If your sale is on monthly basis, your holding cost must be on monthly basis. If your sales is on annual basis, your holding cost must be on annual basis. Since your carrying cost is on monthly basis in the denominator, hence your quantity to be sold must be on monthly basis. 100 units of inventory monthly. That makes perfect sense. 100, S 100, C 50. And your ordering cost, quite a lot of money, 5625, multiply with this 2, and if you simplify all of it, 2 times 100 times 5625 upon 50, and if you take the square root of the value, this gives you 150 exact, which you have here. The last subtopic under inventory management strategy is other inventory management issues. We have discussed just in time in our earlier studies in CMA. I'm sure you know just in time means you purchase inventory only when it is needed. You buy only when it is required. And remember, for implementing just in time, you need to have excellent relationships with your vendor. Vendor dependability is extremely crucial. You have to follow what you call the zero defect policy. Whatever you produce must be perfect in the first go. You have very minimum or almost no chance of wasting material, right? This concept. Then we have a concept called Kanban, which we discussed earlier in CMA, but just you need to know briefly what it is. Kanban, basically it's a system of replenishing the units that have already been used in the production process. Like for example, there are 4 batteries here which are to be installed in an automobile, next automobile and the next. By the time when these 4 batteries are exhausted or used, someone in the warehouse will bring another 4 to replace what are used. So Kanban means a system that refills or replenish the quantity used so that the production process keeps on moving like a well-oiled machine. The workers at this point are not waiting for the input material for the production process to go on. So it's a system, inventory workflow system, where we neither oversupply nor we undersupply, and we plan our production system, the movement of goods in such a way that the work continuously keeps on moving in a smooth manner. Then within this inventory management issues, the other point discussed is the computer inventory control, CIC. Under computer inventory control, supplier 1, supplier 2, supplier 3 who provide me different types of components, they are connected to my system through what you call the electronic data interchange. So whatever I need, the orders are placed automatically to my suppliers. Orders will specify what exact quantities do I need, when do I need, and where do I need. So we receive goods exactly on time, neither before nor earlier, so that we can minimize the time taken for holding and processing the goods. So these are the important points to be considered here in inventory management. Next area we have is the supply chain management, or what you call the integrated supply chain management model. Let us discuss this. What is basically supply chain? Supply chain is the discussion and detailed study of the points where we receive our goods, our material, our services from different types of suppliers. We process these goods into finished goods. Then we give these goods to the wholesalers. Through wholesalers, it goes to retailers, and then it reaches to the final customer. So basically, what we are doing in supply chain management, we are bringing all together our suppliers, our service providers, our distributors, retailers, and seeing them how the raw material moves through this process and eventually is received by the customer. Now, why do we need to go to this extensive detail to see where the goods are originated, where the material is received from different vendors, services are received from different vendors, and why do we need to bring in many parties into this whole arrangement? What we want to do is we want to reduce uncertainty. We want to see the whole system of our supply chain, where goods or raw material is received, in what quantities, how when this raw material is converted into finished goods, what quantity of finished goods to be provided to the wholesaler so as he's not out of our goods, what quantities to be delivered to the retailers, and eventually how many units would be demanded by the customer. So it's a detailed study. We just want to predict the variability of our demand in supply chain so that our customers, they don't feel trouble when they need our goods. That's what we want to. We just want to make sure that needs and preferences of customers are taken care of, and we are able to meet the demands of our customers. We are able to satisfy their demands when and where they are needed. For this, we have a very interesting model called the Supply Chain Operations Reference Model, also called the SCORE model. This model was basically developed by Supply Chain Council, an international consortium. This is basically a generic model. It's not some enforceable document that you have to follow in your supply chain management models. It's just a guideline. It's just a generic model, and using this model will help you plan your supply chain accordingly so that you can make best use of this study, so that you can increase your customer satisfaction and be able to meet their needs when and wherever it's possible. So there are some steps given. Let us discuss these steps one by one. I think I have them here in the next slide. Goal, we already discussed, needs and preference of the customers, matching supplies and demand so that our customers are delivered the goods they need on time, where they need them, right place, right time. Now, this model, the SCORE model, which was developed by the Supply Chain Council, it has given you 4 key distinct activities divided into planning, sourcing, making, and delivering the goods to the customers. Let us discuss these briefly. When you say plan is the first step, the first stage. In planning stage, you try to balance your productive capacity with the expected market demand. You will plan for the plant size, what should be the plant size so that we can meet the needs of our customer. We build infrastructure, we determine what is going to be the likely demand in the market, and then accordingly we plan for what should be the level of production so that we can meet the needs of our customer. Then we arrange for how the goods we will produce through our manufacturing system, how they will be delivered to the customer, from where we will purchase the necessary raw materials, right? Or let's say if there are 5 items that go into our production system, A, B, C, D, E, let's say these are the components. Which of these should we make ourselves? Which of these we should outsource, which we have discussed in CMA, make versus buy. This is all in the planning stage. Once it is done, our sources secured, our infrastructure built, now we are able to meet the needs of our customers. The next step is source. Once the demand is planned, resources and infrastructure is built, now we will select which vendors we will select for certain parts. Who are the dependable vendors who can provide us seamlessly in order to ensure our smooth production system. How we will inspect the incoming goods, how we will store them, how we will ensure the quality so that the customers get full satisfaction from our product or our service. And how do we evaluate the performance of our vendor? So this is the second stage. Then the third one is the actual act of manufacturing. Actual manufacturing. Make. Now this make stage will involve all the activities that will convert your raw materials into finished goods. It will involve your production methodology. Which production methodology have you adopted? Once the product is made, how do we test the quality? What kind of packaging should we use so as to protect and preserve the product? The packaging that helps the product to be carried away easily. How we would maintain our machinery, preventive maintenance, how we will keep it updated, and how we will keep on analyzing our productive capacity so as to accommodate the changes that are taking place in the market. And finally, once the product is made, first you planned, then you secured the vendors from whom you will purchase, then you will convert your raw materials into finished goods, then the point comes deliver. Now you have to deliver. Deliver means now delivering the goods to the customers, managing customer orders, setting suitable price that the customers are willing to purchase at, forecasting customer demands, which shipping method should we use, how should we schedule our deliveries. All this is covered in the delivery phase. Then the next, yes, this is important. So when we deploy supply chain management integrated model, SCOR model, there are some expected benefits, of course. You are not just planning to produce for stocking the goods. We want to produce so that we can satisfy the customer's demand. The goods are for the customers, not for my warehouse. So that's the basic genesis of supply chain management. We need to deliver the goods where and when demanded by the customers. We need to constantly keep an eye, constant watch on the demand variability through supply chain management. It will reduce our cost because we will plan ahead. We don't have to go for the rush orders because we produce in anticipation of demand, and our demand forecasting is quite accurate, and we are able to deliver the goods on time, not going for the rush order. So the cost of production would be reduced, inventory management cost would be reduced. There will be optimized distribution. The goods will be delivered where they are needed, when they are needed. Enhanced revenue. Yes, since you are able to meet the needs of your customers, you will get customer loyalty and they will buy from you again and again. And finally, improved delivery time means you will deliver the goods when and where it is needed. You will have integration with your suppliers. Your suppliers are a part of your activities, and they support you in your manufacturing process by delivering the goods on time, when and where you need them, so that you can produce the goods and deliver the goods to the customers when and where they need them. So that's why we need this integrated approach to apply the supply chain management. Identification of inefficiencies where we might be weaker, and it will integrate you with your vendors. Now the last topic here in this module is accounts payable management. Account payable management involves trade credit. Remember, when you buy goods on credit, this is a source of finance for you. Trade credit is a source of finance. When you delay making some payment like salaries, delaying taxes, delaying wages payable, delaying your payables is a source of finance. Buying goods on credit is a source of finance, right? So trade credit is when you buy goods on credit. Accrual means when you delay the payments. And your vendors, sometimes they encourage you to make payment early. They will offer you prompt payment discounts. So should you take this discount? Should you not? There is a formula we will discuss. We have already discussed in the previous model. We'll do it again. So this model will help you to decide should we avail this discount or not, because sometimes if you do not take advantage of this discount, the cost of not taking discount could be enormous. And this is the formula we use to calculate the cost of not taking discount. Sometimes it could be more than 30%. Giving up discount means you are taking a short-term loan that has a effective cost of 30%, which is too high. Okay, here is an example that will make this point clearer. Terranova company's main vendor offers a quick payment discount of 110 net 30, means if the payment is made within 10 days, 1% off, else net payment is to be made in 30 days. If you apply the same formula we discussed earlier, that is the discount percentage upon 100 minus discount percentage into days in year, that is 360, upon the payment period, that is 30, minus discount period, that is 10. Now, if you simplify, it is 18.2%. So cost of not taking discount could be as high as 18.2%. So you should take this advantage of this discount. You should avail yourself of this discount. Now, 18.2 was quite a high percentage. Now the question that you should ask, should you avail yourself of this discount or should you not? It depends upon your cash position. If you have no cash, then you can't pay quickly. You will have to give up the discount. But if you do have cash available, and if you can borrow at a rate lower than 18.2%, this is the cost of not taking discount. If you can borrow funds at less than this amount, let's say 12%, then what you should do? You should borrow. Borrow at 12% and avail this discount, right? This is an important point. If the funds can be borrowed at a rate lower than the discount, then go borrow the money and pay within the discount period to avail the benefit, right? So, and next, use of EFT. You want to have good relationship with your vendors, so pay them on time. Use electronic fund transfer, means the payments are made on time, so your vendor maintains good relationship with you and you will continue availing credit from your vendor. So optimal vendor payment schedule means you need to find an optimal balance. Like let's say if you gave a credit period of 45 days to your customers, that your average customer pays you after 45 days, then your payment period ideally should be above 45, let's say 60 days. Right? If you give credit for 45 days, you should avail a credit of 60 days from a vendor. Ideally, your average payment period should be more than your average collection period, so that you do not run out in the difficulty of running out of cash. Method of delaying disbursements. Sometimes we are in cash crunch, we have shortage of cash, so we have some methods to delay disbursements. What we can do, we can use a line of credit with our bank. This line of credit will ensure that if we have no money in our bank account, the banker will honor our checks like an overdraft protection. So any amount that is overdrawn in your account, the bank will charge a certain percentage of interest. The good thing is that at least you make payment on time and you pay interest on that, but you maintain good relationship with your vendors. You pay them on time using this line of credit, right? So basically, you are not paying to your, let's say you have to pay to your vendor on 60th day, but you don't have cash, so you can use this line of credit facility with the banker and you can pay the money from the bank and you can pay the bank later, maybe after 90 days. But of course, you may have to pay interest charge on this. So you may use these. We'll discuss these as we go along. So defer payments and line of credit. You can delay making payment to your supplier without damaging your relationship with them, and you can use line of credit as we already discussed. So that completes your working capital management part 1, module M4.